Welcome to Talk Tickers. Today, we're breaking down Ultrapar's Q3 2025 earnings call. Now, on the surface, the numbers looked absolutely stellar, but the way the market reacted, well, that told a completely different story. So let's start with the headline that caught everyone's eye: a massive 52% beat on net profit. The company posted 772 million reais, just blowing past the consensus estimate of 508 million. You just can't argue with that. It was a blowout quarter.
But, and this is a big but, despite that incredible number, the stock ended the day down 4.2%. So what's the deal here? You've got this amazing headline, but investors were heading for the exits.
And that really brings us to the core question of this whole breakdown. What did the market see that wasn't obvious in the flashy headlines? Let's dig in and figure out why there was such a huge disconnect between the earnings print and the stock price. So first up, Section 1, headlines versus the tape. Let's really lay out this paradox. On one side, you have these fantastic reported numbers, and on the other, you have the stock chart, which is telling a completely opposite story. And look, this beat was really broad-based. It wasn't just net profit. EPS also came in super strong at 0.64 reais, a good 12% above what analysts were expecting. I mean, by any standard metric, this quarter absolutely crushed it. You could see this strength everywhere you looked. Adjusted EBITDA hit 1.9 billion reais. That's up a really powerful 27% year over year. Operating cash flow nearly tripled. You can bet management had every reason to sound confident on their call. And yet, we come right back to this number. A 4.2% drop on more than 3 times the average daily trading volume. So the market heard all that good news and decided to sell. This wasn't some quiet drift lower. This was people actively getting out. Okay, Section 2, deconstructing the quarter. Let's really get into it. To understand that negative reaction, we have to peel back the layers of that 1.9 billion real in adjusted EBITDA and take a hard look at the quality of those earnings. Okay, so here's the kicker. A really big chunk of that beat, we're talking 185 million reals, came from one-off tax credits in their Ipiranga field business. The market sees that and immediately thinks low quality, non-recurring, it's not part of the core business performance. So you strip that out, and the year-over-year growth drops from 27% to a still good, but way less spectacular, 18%. And this is where the plot really thickens. If you zoom in on Ipiranga, the company's core fuel business, those tax credits were actually hiding some underlying weakness. The headline screamed 12% EBITDA growth, but once you adjust for that one-off item, recurring EBITDA actually declined by 5% year over year. That points to a much tougher competitive landscape than the headline number suggests. At the same time, the quarter was really propped up by the newly consolidated Hidrovias logistics unit. It had an absolute record performance, with recurring EBITDA more than doubling. Now that's fantastic, but it was thanks to normalized river conditions. The market knows those conditions are cyclical and might not happen again next year, which adds another layer of, let's be careful here. And finally, you have to remember the context. Ultrapar's stock was already on a tear, up more than 50% for the year heading into this report. The market had already priced in a ton of good news and a big turnaround. So the bar for a positive surprise was incredibly high, and a beat that was driven by one-offs just wasn't going to cut it. All right, Section 3, management's playbook. So, how is the company positioning itself for the future? Despite the market's skepticism about this one quarter, their overall strategy seems pretty clear. Their guidance for the fourth quarter is actually pointing to more momentum. They're telling us to expect Ipiranga to hold its profitability, Ultragas EBITDA to actually improve, and the Ultracargo terminal business to see a nice recovery. The overall message is one of steady, ongoing improvement. And you know what? They're backing it up with action. They're not just sitting still. They're actively managing their portfolio, selling off non-core stuff like the Hidrovias cabotage unit to sharpen their focus, and then reinvesting in high-growth areas like LNG logistics. This is a management team that is clearly reshaping the business for the future. So let's pull all of this together. Section 4, the next call, our view. What's our take on Ultrapar as we head into the next earnings cycle? You've got a really compelling bull case here. The company is generating a ton of cash, paying down debt to a healthy 1.7 times net debt to EBITDA, and they're even getting a tailwind from a government crackdown on illegal fuel competitors. But the bear case is just as real. The quality of these earnings is a bit shaky, Those core margins at Ipiranga are fragile, and investor expectations are already through the roof. And for all those reasons, our rating on the stock is market perform. We think management is doing a great job executing their plan, but the current valuation seems to fairly balance out all the good stuff they're doing against the risks and that really high bar the stock is already set.
But for those of you looking for a way to play this, here's a potential trade idea. Go long Ultrapar against a short position in the EWZ, which is the big Brazil country ETF. The whole idea here is to isolate what Ultrapar does really well, things like disciplined capital allocation and solid operations, from the broader macro and political drama in Brazil. It's basically a bet that a best-in-class company will outperform the average even in a choppy market.
And as always, please remember, this is not financial advice.